If you're in a savings account today that yields a 5% interest rate, you are losing money. For every, say, $1,000 you hold there, well, you'll see that the bank gives you $50 at the end of every year, and now you've got $1,050. That's your 5% yield. Feels good. So how in the heck are you worse off or even losing money, which is actually what you're doing? Oh, well, that whole scenario right there, that does make you worse off. Your financial ship is slowly sinking. By the end of this video, you'll understand why, and you'll be a savvier investor for the rest of your life. Hi, I'm Keith Weinhold, Get Rich Education founder, Forbes Real Estate Council member, and longtime real estate investor. I also host the Get Rich Education podcast, which is different from this show. That way, you can listen to me on the go weekly with your Get Rich Education mobile app, through Apple Podcasts, or through Spotify. More recently, some online savings accounts have hit the 5% yield mark. It's become easier to find than it was the past several years when rates were practically zero. See, when the Fed pushes up interest rates, it doesn't just increase the rates on your bad debt like your car loan or your credit cards, it increases the yield on your savings side as well. All right, now, so what's wrong with your 5% yield? Well, first, let's look at inflation. When it's 2, 3, or 4%, as stated in the official government CPI, the Consumer Price Index, most everyone agrees that that number is really understated. It undershoots it. Real inflation could be 5%. Well, if your savings account is 5% and inflation is 5%, then aren't you just right back to even? Oh no, it is worse than that. I'll get to that in a moment. Understand that CPI gives a falsely low figure on what your true annual diminished purchasing power of that dollar in your wallet really is. This is due to tricks that they use, like substitution and hedonics. See, CPI does not account for lots of things like changes in product quality, or when consumers substitute a similar lower priced item for what they really want. Say steak is too expensive, so you eat chicken instead. Say that labor costs got so high that now you only have the landscapers mow your lawn anymore and no longer mow and weed whack your lawn. Now you're the one weed whacking it. Well, that is substitution with chicken and weed whacking, diminishing your quality of life. So the real rate of inflation today might be something more like 5%. It could be even higher. If you want to learn more about that, check out shadowstats.com. Well, if your savings account return is 5% and inflation is 5%, let's get back to that. Aren't you back to even? Because at the end of the year, you've got 5% more dollars, but each one of your dollars is worth 5% less, and therefore you might think that, well, hey, I've maintained my purchasing power by using my 5% savings account. Well, you really haven't, because now that we've accounted for inflation, we haven't accounted for taxes. Yep, with every $1,000 you have in a savings account and $50 of interest you were paid each year, that $50 gets taxed in the United States when it's outside of a retirement account. How much does your $50 get taxed? It depends on how much you earn each year. Your interest earnings get taxed between 10 and 37%. That's the federal tax rate on your $50 in this case, your $50 that your $1,000 earned. All right, well, on that $50, let's say that based on your income, your tax rate is near the middle there, 24%. That means that your $50 is dented down to $38. Now, your after-tax savings account's rate of return is just 3.8%. It's no longer 5%. So your $1,000 gained $38 of after-tax interest, and then inflation knocked $50 off of it. So that's a negative $12 per $1,000 that you've invested. So now your real inflation adjusted and tax adjusted rate of return on that 5% savings account is minus 1.2%. And we're still not done. But now you're already underwater. That's the sinking ship that I'm talking about. You're not even treading water. Even treading water would mean that you're not going anywhere or growing your prosperity. You would just be staying in place. But no, you're actually on a slowly sinking ship, not even treading water. You're not losing currency, but due to inflation and taxes, you're losing prosperity. But that's not all. It could get even worse. That's because we've only accounted for federal income tax so far. Does your state have its own income tax too, on top of the federal income tax? Yes, more than 40 of the 50 US states have their own state income tax. We still might not be done here. Do you have to pay local income tax in addition to all of that? Ugh. See, it feels pretty unfair to consider that in the United States, taxation is not adjusted for inflation, so you pay them both. And of course, you can't game the system. Banks report to the IRS any interest payments of $10 or more, and they send a copy of that to you too. There's no getting out of the income tax here, and there's also no escaping what I'll call the more surreptitious inflation tax. I've got more here. Hey, go ahead and hit that like button if you like the value and perspective that you're getting here. I'd appreciate it if you want to hit the thumbs up there. All right, well, as discouraging as this sounds, what are you supposed to actually do about all of this? Because you know that any $20 bills that you kept in your wallet overnight last night, well, they're worth less today than they were yesterday. And now you're more aware that holding dollars in a savings account has likewise debased your prosperity. All right, well, how much liquid savings should you hold onto? And then in what form should that take? Like, how should you hold onto it? If not in dollars, what about gold? Maybe, but gold has its own spot price differentials to overcome and its own taxes. How about Bitcoin? Well, maybe it has its own taxes too, and a lot of volatility. Too much for most people's safe, liquid part of their wealth. I still think it makes sense to hold some of your liquid funds in dollars, just not too much of it because of what I've already shared with you today. Old school personal finance says hold 6 to 12 months of your living expenses in liquid savings. If you're a real estate investor, like a lot of us here are on this channel, in addition to that, you want to hold 3 to 5% of the total value of your income properties in liquid cash. And you know what? If you hold any more than those amounts, well, now you've learned the opportunity cost of savings accounts. Say that you can make a 25% return per year by putting those dollars into your own business, or a 30% return per year by investing in income property. We show you how to reliably do that here. Well, in either of those scenarios, then your opportunity cost is what you could have made in those vehicles rather than in a savings account. And that's why here at GRE, we invest in vehicles that target returns that vastly exceed both inflation and taxes in a conservative fashion. And now you know that even if you happen to have a 5% savings account, your inflation adjusted federal tax adjusted return is a negative 1.2%, and state and local taxes can make it worse. Now that you understand that, well, hey, I'd like to hear from you, and I will try to reply to you myself. Tell me in the comments, what do you think that the real rate of inflation is today based on your life and on your consumer patterns and what you see? You think it's 2%? Or 14%? I mean, this might be your favorite dish at a restaurant was $39 a year ago and it's $45 today. Whatever it is, let me know. Engage with me in the comments. I'm Keith Weinhold. I'd love to chat with you right here in the comments.